Hello everyone, welcome to this edition of Know Your 4C Fund Manager. I'm Narender Reddy, Head of Investment Advisory at Motilal Oswal Private Wealth. Today we have with us Mr. Prateek Agrawal, Executive Director at Motilal Oswal Asset Management. Prateek is an industry veteran with close to 3 decades of experience in Indian equity markets. And prior to joining Motilal Oswal Asset Management, he was the business head and CIO at ASK Investment Managers. He also had stints at BOA, AXA and BNP Paribas as head of equities. It's a pleasure to have you on the show, Prateek.
Thank you.
Before we get started to understand the investment frameworks and the funds at Motilal Oswal Asset Management, we would like to take this opportunity to get your views on markets in general. So there's a lot of noise that's going on around the global macros with slowdown in developed markets, with Fed rate hikes, and now with the new fear of US debt ceiling talks kind of failing. So where do you see the entire global macro setup?
No, so let us put it this way: India and the world. Our forex reserves, in some manner, act as a dam between the tranquility that is there in India and the volatility that is there across the world, including developed markets. Now, as long as our forex reserves maintain their levels or have a upward buoyancy, I think the degrees of freedom that our policymakers will enjoy will be there. And if you see the way interest rate increases happened, they kind of coincided with a period when our forex was depleting, and somehow it has again coincided with the period when our forex started to move up. Okay, and I dare say inflation, no inflation, what is happening in the West doesn't matter, but if a country loses forex steeply, the country will again have to increase interest rates to stop the bleed and maybe slow down the economy. So forex is the dam. Now second thing is, yes, global growth being slower impacts our exports, and to that extent impacts our growth. Now, what percentage of our economy is exports, and how much slowdown do we expect there because of slower global growth? And if we map it, it would turn out to be like 18% of our economy may be export linked. If the world slows by 1%, 18 bips is the kind of slowdown that we will experience because of slower global growth. Now, today is a situation where you can't have both, faster global growth and lower commodity prices. So, my sense is if the world was growing more rapidly, oil won't be at $70-$75 range. It will be $85-$90 range. And, it will be like you get something from one hand, you give away something more from the other. And net all impact on the country won't be much. So today I am okay. I think it is good. Global is slowing down. Commodity prices are coming down. Inflation is coming down. It is great for a high growth country like India, where growth, like I said, export slowdown will result in an 18 bips shave off. That will then need to be made up from somewhere else. That was the export linkage. If you look at the Indian macros itself, inflation is coming down. Our policymakers avoided a rate increase last period. Growth, yes, will slow down versus last year, both nominal and real, from 15% nominal to 10.5% nominal this year, for example. But then there are spaces where the growth will continue. And my construct on the index is 18.5 times 1 year forward. So if to 24 earnings you are taking at between 950 and 1000, I think we are at very, very defendable levels on the index with the outlook of earnings growth kind of compounding going forward.
Sure. And like you rightly said, now with growth fears globally, the commodity prices have started to ease off. And the other reason for inflation was also your supply chain bottlenecks. And those also seems to have been kind of behind us now. With these things happening, some of the companies which are consumer facing, which are facing headwinds over the last 1.5, 2 years, do you see things changing for them?
No, so the consumer companies with pricing power have been increasing their prices over a period of time.
Yeah.
Now, if their raw mat cost goes down, clearly there will be an expansion in margins.
Sure.
And while it may be a tad unfair, but they do end up retaining a large part of it, and the market gives a multiple to that. I think some bit of that has already taken place. So if you look at a period between Jan and now, this part of the market has done very well, particularly in the month of March and April.
Sure.
Now, longer term, can it continue, especially the staples part of the market?
Yeah.
See, my thought is that in the journey of country, as it moves from a lower per capita to a higher per capita, इसको कहते हैं रोटी कपड़ा मकान takes all of the mind and wallet share in the beginning.
Yeah.
And staples come there, okay, but as you grow beyond that, they stay there. They can't just keep expanding their presence. So except for names hence where premiumization can be a big part, I think rest of the staples will slowly fall behind.
Sure.
And I think to some extent you are already seeing it in the marketplace.
Sure. Both in terms of price correction and also the time correction that
both,
we have seen.
Yes,
for
absolutely.
the last
And relative performance versus the other space.
Sure. So in this backdrop, I mean, what are your preferred sectors, themes going forward?
No, sure. So what we did was to sit as a team, 9 managers, myself, Arya, Naveen, all in one room, and fleshed out narrow themes where the growth momentum can continue for a longish period of time. We are quality and growth focused investors. QGLP is the philosophy that we follow.
Yeah.
So to give you some example, number one was financials. We said we continue with banks which are retailish in nature, start to would have business as usual versus corporate bank. So what happens in a corporate bank is you lend to corporates and let's say working capital. Now if inflation goes down, the growth in working capital goes down because it's inflation linked, for example, and hence you have growth headwinds. Okay, versus that for retail it is business as usual. So we think retail-oriented banks will again start to do a tad better, relatively speaking, and which is what we have in the portfolios, and along with them, NBFCs who keep on adding newer verticals, which reduces the cyclicity of the business and provides a growth momentum. So that is on the financial side. Then coming down to, let's say, healthcare, which is a recession-proof kind of an industry. I think in that space, we are more glued down to hospitals and medicine retailing kind of infrastructure, because that is where an organized to organized play is super strong for one, and two, the need is very, very palpable. If you look at India as a country, yes, we are a very young country, but if you look at age cohorts of over 60 years, the growth that each of these cohorts will see will be way higher than any other cohort in percentage terms. So the need for this infrastructure is just going to be very, very high going forward. And during the COVID times when expansion slowed, the the actual profitability, the ROCs of the space became more evident, and I think marketplace is now getting clued there. And this is a space where inflation happens a tad more than the inflation in the country itself. So this is that kind of a space. So that is the other space. Then the third one, the big one, is consumption.
Sure.
Now, versus staples, which we spoke about, we are more with discretionary, mostly with high-end discretionary. So stuff like wedding clothing, stuff like premium shoes, Jewelry is where we are invested, malls selling premium products, and maybe stuff like fast fashion. Where you companies have found a good and a fast growing space. So this is the other difference that we have versus other players in the high quality, high growth space. Now the next is technology.
Sure.
So on the software services side, which is like 11% of the index, we are less with the larger caps. We are more with the mid caps, which are focused in spaces which are still seeing strong growth. So travel, leisure. If you are European focused, then Europe is starting to outsource versus US, which is already way ahead. Then autos, connected cars, electric vehicles. Telecom 4G to 5G kind of a change and so on. So, businesses which are placed there have our interest. And yes, there are a few mid-cap companies who earlier were so small that they did not qualify in the larger size deals.
Sure.
Now some of them are crossing $1 billion, maybe $3 billion of size, and are qualifying in a more wider spectrum of deals, increasing their growth outlook. So that is where we are positioned. That's our. And in tech again, we believe new tech. This is a space where we are seeing businesses rapidly transitioning from losses on the EBITDA to break even over the next year and a half. One should see that. And growth runway is very long. We say these are good businesses, the valuations are still good. While yes, there will be volatility because of private equity ownership changes. These are broadly the large part. Other spaces where we believe growth will continue to be strong is engineering. So we have some exposure to MNC engineering companies, and defense. So that's a big theme in the country. And the other one which benefits from China plus one and now increasingly China plus one kind of an outlook globally is the chemical space.
Sure.
So I have outlined to you practically all the themes that we are running with and believe that most, if not all, would do well irrespective of a slowdown internally or externally, and give ourselves, our investors, a very long runway of growth. Growth and order higher than that of the index, so that higher growth itself delivers some alpha to the clients after cost.
Sure. While I would like to dwell more on your investment frameworks, but in all these high growth businesses, do you see value as a key parameter while picking up stocks?
Yeah, so P is the last part of QGLP. So quality, we have put a minimum filter of 15% for ROICs or higher. G and L I spoke about. We found themes, and every manager finds stocks to his liking in the themes. And then for valuation, which is the last bit, we have always had a framework called based on ROE and PEG ratios. On top of it, what we have also done is to roll out a DCF framework, which enriches the conversation internally, and avoids us getting into businesses which may have a low terminal value. So that is something we have done. I think on traditional valuation parameters, our growth adjusted valuations to our mind are very attractive. So what we do is to find themes which are long period, and then bottom up find stocks where you get some amount of valuation comfort. And if you see across the house, you would find that growth adjusted our valuations look very good versus the index.
Perfect. And while Motilal Oswal Asset Management's QGLP framework is very well known to all the investors, we wanted to bring or ask some of the changes that you could have possibly done to this robust framework to kind of beef it up further.
So we spoke of that, have a number for quality.
Sure.
15% ROIC is something that we
Sure.
have done for ensuring quantum of growth and quality of growth. So, both are important. If there is a large quantum of growth for a short period, you can't make money.
Sure.
Quantum of growth is required and also longevity of growth. And
Sure.
for that, we spoke about all the themes
DCF
which were
and
there.
terminal.
And for pricing, we rolled out a DCF framework. So we did all of that, and then what we have also done is to roll out a full-fledged risk control framework.
Sure.
On sizing of stocks. So, we want to be increasingly seen as a house which people put as a core of their portfolios.
Sure.
Lower in risk, trying to provide sustainable performance. Lower risk because now you will not find heavy weighted stocks in the portfolio. Typically the highest weight, be it alternates, be it mutual funds, would be 10% with market action.
Sure.
Otherwise 9 is max a manager can buy. And then we have regular profit taking processes to bring it down.
Sure.
Again, gone are the days when we would be happy or we would be comfortable with significantly higher single stock weightages.
Nice.
Yes. Similarly, on the flip side, the bottom part of the market, we have put a number. We would like the weightages to be in excess of 2%, closer to 2.5%. I think on the journey, we are now over 1.5%. If you see smaller holdings, it is more because either people are getting out or it's an IPO where we have gotten some anchor allocation and it's not to our liking. It's smaller than to our liking.
Sure.
So that is again something that we have enforced. Third, we have put in stop loss processes.
Sure.
So names which have not been performing for a longish period of time, are highlighted. That's the first instance. Managers decide to keep. It's their choice, but we are encouraging people to be aware of the process because at some point in time the process will come and cut it.
Sure.
And the best outcome is that the manager is aware of the process and takes a decisive action in time. We really want to see a larger part of the portfolio work for the investor rather than not work for the investor. So, half the battle is won if you showcase to the manager that this is how the portfolio is behaving. So that is something again that we have done. And then in the portfolio construct itself, we have built in risk awareness. So, some part to be represented by themes, some part for the manager to represent his ideas, completely bottom-up ideas, which the themes may not be able to capture. But the last 10% we are saying be aware of the risk in the environment. The risk could be that, for example, in an index, 2 large names may start to move and you don't have them. Well, if you believe they are going to move, cover that up. If there is COVID, for example, move that staples percentage up. Like I said, this was a risk which was highlighted. Our portfolios are not there in staples, they are more on the discretionary side. Now, if there is a COVID, well, discretionary doesn't do well, staples do. And if you look at January kind of a period, you would find some managers buying staples in the portfolio and getting out when COVID receded. Similarly, what happens in the portfolio if interest rates move up? What happens if currency depreciates? Both of these things were happening over the last 3-4 months.
Sure.
And again, we did sensitivity of our portfolios to see what percentage, benefits, what percentage does not, to see if we get a balance or not. And happily on this, both were getting, we were getting a good balance and no changes needed to be made anywhere. So, risk awareness has just been increased and increased within the house. We want to be super focused on quality so that we don't have errors of commission.
Sure.
We want to be more inward looking rather than outward looking. So ideation is a great strength of the house. But then over ideation just results in some mistakes here and there. We really want people to first look at what is internally held, for example, compete with something that they may be liking externally, and unless the gap is very large, it is better to probably populate the portfolio with what is already invested. So on this journey, I think we have moved. At the end of October last year, for example, we were with 185 names on the house. On the active side, today we have reduced that number to just over 150, and we are trying to reduce it a bit more. Happening automatically because you compete with what is there internally rather than bring a new name in. So when you get a new name in, you don't know about it, chances of errors are higher. So that is something that we are doing, and yes, like I said before, we are in the business of risk taking. Mistakes will happen. Starting with high quality reduces that chance. Being inward looking reduces the chance of making mistakes, but mistakes will still happen, and then the idea is to quickly recognize them and take corrective actions. Obviously, the manager has a final call. But then if you look at our house, in the month of October, there were several names which were in the stop loss kind of a situation. Today, if you see, many of those names are actually out of the house, and happily, in retrospective, at good times. What remains would be like 1/3 of the original quantity, where a manager may be like super convinced on the evaluation and would want to hold. But as a house, we definitely reduced risk considerably in many names. So lots of things to demonstrate. I think clients who are watching us would very easily notice the sizing part of it, both at the top and the bottom, and the size of the portfolio. So in the end, what you have across the house is a high conviction portfolio. Every portfolio that we run today is a sub 35 stock portfolio. In that manner, we are a very, very unique house. So if you look at our mutual funds, we are the only house which does focused high conviction portfolios across. In that manner, offering a great value to the clients. So my whole thought is, if you divide your managers into exponents of value style, exponents of high quality, high growth style, we believe we are very good exponents of high quality, high growth style, and in that style we give you focused high conviction portfolios with a very strong overlay of risk.
Both in terms of managing the concentration,
everything,
in terms of not building too much of a longer tail, and the stop loss mechanism,
risk control processes. So you get the benefits of focused portfolios, and hopefully at a risk of much more diversified portfolio. In some sense, if you see, Nifty is a 50 stock portfolio, a BSE 30 is a 30 stock portfolio, yet both move almost similarly every day. So that is what we are really trying to achieve.
And in your previous organizations, while you have created many portfolios, be it on the value side, be it on the vision side, or also in terms of backing up the Indian promoters. So you have created portfolios largely driven or focused on businesses run by Indian promoters. And now at Motilal Oswal Asset Management, you seem to have launched something called a Founders Fund. What is this fund all about?
Let me share some bit of experiences which I had over a period of time, which resulted in this franchise becoming what it did in my earlier organization. So actually, what happened was, going back the memory lane, in the AXA group, so which
Sure.
was where I was before ASK. Now, AXA then between 2008 and 2011 was the largest money manager globally. Even now it will be top 10 globally.
Yeah.
Now, globally, people grow organically, but most of the growth comes inorganically. They keep buying each other out. If that size of a company buys a few billion, few 100 billion kind of an entity, it is normal, and it doesn't catches the eye. It is what they keep doing all the while. But if that size of an entity buys a $150 million franchise, then it seems very odd. So, which is what happened, and there was a small franchise which they bought, which was focused on backing entrepreneurs
Sure.
through actually their holding companies, which is when this thought that it is the entrepreneurs which take risk, build the capital stock of a nation, make a nation grow through their vision and their endeavors. Of course, in an emerging country like India, backed by the government, government provides a tailwind. Frankly, was a huge change in thought process that I encountered. My background is public sector. You did not touch upon the SBI Capital 10 years,
Yes,
and before
the head
that,
of research.
before that, I have been raised in a steel township, sales steel township. So my background is very, very PSU. I thought PSUs build the country. I thought government build the country, which is when, in AXA, I first got introduced to this thought that, while all of them may provide tailwind, they may provide catalysts, but it is the entrepreneur, it's the guy who is taking the risk, putting money at risk, who actually builds up the country. And then when I moved to ASK Group, there was this small fund, 80 crores, if I remember right, of the size at that point in time, which you try and find something familiar in a new platform. This was something familiar. Managed a tad differently, but something else which was very close to my heart was managed in one manner.
Sure.
So high quality, high growth, quality defined in a particular manner, translated into numbers, growth, what order of growth that we want. And since we had there, converted the philosophy into a process, the style purity was very, very good. So, so these are the learnings, okay, and we managed to the T. You see how we did it. This is what we did. High quality, high growth entrepreneurs bring, want to grow faster. They put in their toil, they put in their energies, and if they are good in quality, they have succession planning. People who associate with them make money. So that's the very simple thought. But managed in one manner, over 11 years, resulted in very good performance track record for most of that period.
Sure.
You end up selling a philosophy rather than selling a stock. It becomes very easy for sales to sell. It becomes very easy for the client to understand. And if you keep demonstrating that this is how the portfolio is built, with each name matching up to the philosophy,
Sure.
and in that period performance definitely coming in, and we can talk of the tailwinds which were there.
Sure.
Helped build that fund up to a peak level of 28,000 crores. Now here, obviously this is something that we want to replicate.
Sure.
With a lot of tweaks actually. So it is similar and not similar. One, we want what we want is the growth DNA of the management. So yes, we have parameterized it with let's say 26% of promoter equity at the minimum.
Sure.
But at the same time, we have made a leeway for people with large ESOPs. So, while many a times we believe that it is the promoter who is driving it, what we see is the best thing the promoter may have done is to find a equally charged up or even more charged up top management.
Sure.
And there are enough and more
Examples.
examples of the same. So, we say if there is a great guy at the top who is aligned to small shareholders through, sizable ESOPs, we are happy to look. So that is one change that we have done. I mean, a lot of the successes that we have seen over the past few years were actually the work of the top management,
Sure.
which was not a promoter.
Yeah.
And we want to harness that. Second, what also happens is some of these newer age businesses, which is where entrepreneurs of the day are making a large change, don't have a large equity, stakes. So, can we deny that they have fire in the belly? No, they are making a change for the good for the country. And in this kind of a fund, which is so much growth oriented, we have to, in the construct itself, provide them space.
Sure.
And this thing does that. The other thing that this does is, for example, in banks, where by the rule of the law, banks have to bring down promoter stake to below 25%.
Yeah.
Now some exceptions are being provided, and slowly, a large space like banking, which is overall banks plus their subs and insurance, capital market, etc., put together is 35% or thereabouts in the index.
Sure.
The choice for an founder's portfolio would have gotten very low, but because of this tweak, we are able to be invested in private sector banks. So, this is one change that we did, and the other one that we did was to include businesses which may be on the path to profits, while today they may be making losses.
Sure.
Because it requires some extra monitoring, but if companies have come and projected profits over a foreseeable future, and every quarter they seem to be on the path, I think this journey is where, from a disbelief, people start to believe. There is sizable amount of value creation that happens. We want to benefit from there. So it's not like we will put one name, large percentage there, but divide that into 2 or 3 names. We and 8-9% of the portfolio. We want to create space for that as well, because this is what founders, promoters, entrepreneurs are all about.
Sure.
Otherwise, what happens is the product veers around to investing into more staid, maturing businesses rather than younger, faster growing businesses, which this whole thought is supposed to capture. Now, when you do this, how do we provide the other big thing which an investor requires, which is preservation?
Yeah.
So preservation happens because, one, you start with a high quality.
Sure.
2, because you don't take any large bets on any name. So, today in the construct, for example, it's a 22 stock construct.
Sure.
Equal weighted. So, 4 point something percentage is the weight of each name in the portfolio.
Sure.
Of course, moving by the movement in the marketplace itself.
Yeah.
Third, what we are also doing is, like I described before, looking inwards. So very few names, if at all, are names where this fund becomes the first buyer of a stock.
Sure.
Okay, we are invested in a lot of names as a house, and 90+% of the portfolio is invested into names where the house has been invested for some time. When you are invested in a name for some time, you understand it better. You have time to see whether the thesis is playing out or not, and thereby avoid error of commission. So this is what it is, and then all the themes that we are talking about
Sure.
get represented. So in terms of performance, we believe we are quality and growth, and on growth we have captured all themes. So whichever part of the market works, I think we should participate. And then what we have also done is to construct a portfolio which has presence across the board.
Sure.
So, it has come out, it was less planned, but it has come out that way. That every 20,000 crores from zero, if we move, we have like 20% positioned in the market of the portfolio. So, whichever part works, I think something in the portfolio should have some tailwinds. So that is basically the thought: provide preservation, provide growth and order larger than the index. 2-year numbers, I think, are in the projection period itself, but because of the growth tailwinds, which we believe would be there because of the themes we spoke about, our companies should be able to deliver growth over the next period as well, not only 2-year, 3-year projection period. Thereby, over the life of the fund, provide an alpha to the client.
Sure. Sure. So essentially, there are no market cap limits. It's a sector agnostic fund, can straddle anywhere across the opportunities that kind of come up. And fairly well risk managed with no high concentration. At the same time, it is equally spread out, so there is no large tail end of the portfolio. There were 22 stocks at the moment.
22 stocks total at the moment. Maybe we go to 23. I think we stay there. So high conviction across the portfolio, and I keep seeing it. If every name does a bit more than the index, then I think as a portfolio we should be fine.
And how actively the portfolio would be managed over the life of the fund?
Tend to look at returns in sum of two baskets. One is compounding. So that we spoke. The whole thought is 100 rupee EPS moves to 120 to 140 to 160. The value of the business is increasing.
Yes.
Give market time, it shall reflect that.
Sure.
The other capture that one can do is to buy cheap something.
Sure.
Something which is worth 100. If you are able to buy at 80, you again have this 20 bucks to make. But this can happen, at the beginning maybe, when you are constructing the portfolio for the first time.
Sure.
Or when you rebalance, or when you change,
Sure.
right? Now, and hence we believe we will end up changing 25% of the portfolio in a year. So 5 to 6 name change one should expect in a year. Second, rebalancing churn of another 10 to 12%.
Sure.
So that becomes close to 40% after the portfolio. Now the first bit has been done. So 40% kind of churn is something that one should expect to see.
It will be a fairly actively managed portfolio.
It will be a fairly actively managed portfolio, yes.
And can you give color of the portfolio currently in terms of market cap allocation, in terms of sectoral allocation?
No, so we spoke of that. So, for example, financials are today 5 names on banks, 1 on NBFC, so 6 names, 4 point something, 24, 25%. Then we have chemicals, 2 names, put 4 point something % on each, okay. Then we have new tech on 3 names. Then we have a software service company, 1 name. Then we have consumption, all high-end luxury consumption, 4 names, including one mall kind of a player. So that broadly gives you the portfolio construct. Chemicals, 2 names, hospital, 1 hospital,
Yes.
1 medicine retailer. So that kind of completes the portfolio. So that is what it is. Very easy to understand. I would believe many of the names, when people see, we showcase the portfolio first. It's
Sure.
not hidden.
Sure.
We are happy to get feedback
Sure.
that this is risky, this is not. And like I said, preservation is something which is up there in what we want to deliver. If our clients, anybody who knows or who could know gives us a feedback that this is something which is not fitting in, we are happy to take that feedback. But otherwise, I would believe most people will love the construct, love the growth stories associated with each name.
Sure.
And this is our promise. We will keep doing this.
Sure.
We will keep doing this, trying to think through themes, best exponents of those themes, and then build the portfolio. So engineering we missed. Engineering is something where on the founder side there is less choice. So we are representing it through cable companies. So we have 3 companies there, and the whole thought is cable is something which goes into any construction, residential or factories,
Yes.
and the players will benefit. So that is the thought, and I think that completes the portfolio.
Sure. And how does this portfolio complement other core strategies that are there in the market, and also the index funds that are there as part of the core portfolios in investors' overall portfolio?
Yeah. No, so I would believe, like on the debt side, the liquid funds have most amount of money. Similarly, on the equity side, the largest amount of money over a period of time would be index funds.
Yes.
And happily, we as a house have a lot of them. So, but then as we move up the return expectations, yes, it comes with a degree of risk. I think is where then some of these of our products are positioned.
Sure.
And on the founders, the thought is that the growth should be an order higher. If you don't get the starting valuations wrong, then growth itself should end up delivering significant alpha after cost to the end investor. And if we are able to capture some amount of discount to value, the outcome should be even better. So that is versus the index and index related funds. Now, the other way to look at us is we are exponents of high quality, high growth investing. Now, so which means we complement everybody who is an exponent of value style. So I keep saying this: you want to get out of the house, you don't know whether it will be rainy or it will be sunny, so you carry an umbrella and you carry a raincoat, and you are pretty sure of reaching your destination in good shape. In the same manner, in the marketplace, a value style may work sometimes, a growth style may work in another time. And hence, if an investor populates his portfolio with some of the best exponents of value along with us,
Yes.
we believe we are the best exponent of high quality growth. And I spoke about the how we go about the QGLP framework,
Yes.
the philosophy converted to a process, etc. Whichever style works in the marketplace, the investor should be fine. That is point one. Second, in the high quality space, suppose the investor wants more than one product or more than one exponent of the style. We incidentally, and we have observed this, it's happening automatically, we seemingly provide a lot of diversification benefit. So if you look at our portfolio versus other exponents of the same style, the overlaps are very low. And this is happening across, our mutual fund versus other top mutual funds in this space, overlaps are sub 35% to my mind. Our alternate funds versus other alternate funds in this space, similar or lower overlaps. And I think the same thing will be true for founders as well. Yeah, so and hence versus any other fund in this space, it is a great complement. I think it's happening because we are a tad lower on quality, okay, but way higher on growth, and that makes the valuation equation much better for the construct that we have versus what other people have. So I think with time, the difference in performance should start to show up.
Right.
In any which ways, we do hope to provide very good diversification benefit. So that is our product positioning for the client. Very much in the core part, a tad over the index funds. Have one part for value, have one part for growth. I think we should qualify for a very large part of the high quality growth style.
Strategies. Yes. No, thanks so much, Prateek, for taking out time and sharing your insights on markets and the frameworks and the beefed up risk management at Motilal Oswal Asset Management and the Founders Fund. Thank you very
My
much.
pleasure. Thank you so much.